Shares of Adobe dropping a little bit in early morning trading on Friday in response to the company's quarterly earnings results. What happened this quarter that has Wall Street feeling a little bit upset? Here's everything you need to know in about 10 minutes. My name is Brian Feroldi. As of the time of this recording, I do own shares of Adobe, a $251 billion market cap company. Revenue this quarter grew 10% to $4.89 billion, exceeding Wall Street's estimate and management's own guidance. Earnings per share came in at $4.09 on a non-GAAP basis, also exceeding Wall Street's estimate and management's own guidance. Turning to the company's segments, Adobe Creative Cloud, which has many of the products that we are most familiar with when it comes to Adobe. This business grew 11% year over year to $2.91 billion, $332 million in new creative annualized recurring revenue. Very good results for that business. Management credited the strong results to Adobe Firefly, which is their brand new AI tool, which is seeing millions of users and uses. So Adobe is becoming a player in the AI game. Turning to the Experience Cloud, these are tools that help publishers and advertising to create and distribute marketing content. This business grew 10% to $1.23 billion, so nice results there. The final segment is Adobe's Document Cloud, which includes Acrobat Reader as a whole bunch of web services. This business is the smallest, but it grew 13% year over year to $685 million. Adobe said that it was seeing good results here. Turning to margins. Margins were excellent this quarter. 88% non-GAAP gross margin, up year over year. 34.7% non-GAAP operating margin, incredible, up strongly year over year. Net margin nearly 29%, up 210 basis points. Great margins. Free cash flow production was strong at $1.8 billion. Net income was $1.4 billion on a GAAP basis, up year over year. Balance sheet is in excellent shape with nearly $4 billion more in cash on the balance sheet than debt. In other financial news, the company did repurchase about 2.1 million shares, and it has remaining performance obligations of about $16 billion. So lots to look forward to for this company. Digging into the income statement a little bit more, we did see that expenses rose a little bit, with the biggest jump coming in sales and marketing and overhead costs, but that pace of growth was slower than total revenue. And when you combine that with a share count that declined 2% year over year, hence the big jump in earnings per share. Now, I read through the call. There wasn't really a lot to say that management had to say that was really all that noteworthy. The only thing they did say is that the pending acquisition of Figma, they continue to have conversations with regulators about that case, so nothing big there. Turning to guidance, management is expecting about 11% revenue growth in the upcoming quarter to about $5 billion, right in line with Wall Street's estimate. Earnings per share on an adjusted basis are expected to be about $4.10. That's above Wall Street's estimate. You'd think that would be pleasing Wall Street today. For the full year, management did not update its full year guidance. So this is guidance from last quarter. Last quarter, management guided for about $19.3 billion in total top line revenue, roughly in line with Wall Street's estimate, but given this quarterly result, perhaps that number should have been ticked higher. Perhaps that's one reason why shares are declining today. For the full year, Wall Street management is expecting about $15.70 in adjusted earnings per share. That's roughly in line with what Wall Street is expecting, although given the earnings beat this quarter, perhaps that number should be moving higher. Overall, what am I going to keep my eye on? For me, it's revenue. That is the growth driver here. 2, margins. They remain very strong. Want to keep that continuing. 3, buybacks. Want to see that happening. And then 4, that pending Figma acquisition is a big deal for investors. If I had to rate the moat, I would say it's stable. AI is definitely a threat, but Adobe has some AI products of its own. So I would view it as stable right now. That might be a little bit misguided, but that's my current view. But the thesis for the stock remains very much on track. We reran this company through our investing frameworks. It continues to score very well, hence why it is in my portfolio. Turning to valuation, Adobe is very clearly optimized up and down the income statement. So that puts it clearly in the capital return phase of the business growth cycle, which means that we can use the price to trailing earnings and the price to free cash flow to figure out this company's valuation. So let's do that by using the sponsor of today's video, which is YCharts, an incredibly powerful tool that we use every day. So let's start with the price to sales ratio, currently about 14 times. That's above its 10-year average. So a little bit pricey on a price to sales basis. On a price to gross profit basis, this company's market cap is about $252 billion, about $16 billion in trailing 12 months gross profit. That puts it about 17 times price to gross profit. Quite pricey, but given the company's margins, makes sense. On a trailing price to earnings ratio basis, this company is creating about 52 times trailing earnings. That's above its 10-year average, although that average is certainly warped by the transition to the cloud in 2014 and 2016. So its shorter term average is a little bit lower than that. But the price to forward earnings ratio, a more meaningful metric to me, this number is currently about 35 times earnings. That is above its 1-year average of about 28. So shares are a little bit pricey right now on a price to earnings basis. On a price to free cash flow basis, right in line with its 10-year average of about 35. You can see that this company's price to free cash flow ratio got all the way down to about 18 in the bear market sell-off of 2022. And it's just about doubled since then. So what a bargain this company was back then. One more tool I want to introduce to you is the shareholder yield number. This is the inverse of the company's total capital return program. So the shareholder yield here is about 2.71%. That's near a 10-year high, and it got up to about 3 previously. So Adobe looks, I would say, fairly valued to modestly valued, at least on a multiple basis. And thank you to YCharts for sponsoring today's video. One quick note about YCharts. They just announced a brand new tool that they call Proposals. This tool will enable wealth management professionals to create some beautiful visuals that they can use with clients to help convey their investing strategies. Next Friday, September 22nd, YChart is going to be hosting a free webinar to show off this tool's new total potential. If you're interested in checking out this tool, as you should be, there is a link to that free webinar in the video description. And if you mention my name off at checkout, you will save 20%. So thank you to YCharts for sponsoring today's video. One last valuation tool I want to consider with Adobe is the reverse discounted cash flow yield using our little tool that we created. We put the ticker in here, the company's trailing 12-month free cash flow of about $7.7 billion, a 2% terminal, 10% discount rate. If we assume 0% growth, this should be a $200 stock, or $187 stock. So you have to assume about 15% growth, 15% compounded growth in free cash flow for today's valuation to make sense. So that is the key question for investors to ask themselves today. Does 15% growth in free cash flow over the next 10 years seem doable to you? On the one hand, that does seem to be a pretty high bar. There will likely have to be acquisitions built in there to get that number going, given how high this company's free cash flow margin rate is already. But who knows? This is a very high quality company. I think double-digit free cash flow growth is reasonable. Whether it gets up to 15% or not is another question, but I would not be surprised if the company could do it. Overall, I think this is a fabulous, well-run company, and I look forward to being a shareholder for many years to come. Hope you enjoyed this review. If so, please let me know in the comment section below. If you want a free copy of my reverse discounted cash flow calculator that I just showed you, there is a link in the video description below. See you in 90 days on this one. Brian, out.